Question. Have you ever paid down your debt, watched the balance go lower, and still felt like you had no room to breathe? That is not always a discipline problem. Sometimes the system is measuring the wrong thing. I've spent years studying how credit, debt, banking, and cash flow interact. And the problem I keep seeing is this: people are reducing one number while another number continues working against them, and the system never tells them that at all. And this is something we've got to understand. The system just keeps on allowing you to go through a seeming process. But what keeps your cash flow stuck, and how to tell the difference between progress on paper and real improvement in your financial position? Because the truth of the matter is this: the most important number may not be the balance you are paying down. It may be the unusable cash that remains after the system collects its interest, its minimums, its fees, and its fixed obligations. And once you see the difference, you will understand why some debts, plans look simple, successful, but still leave people financially exposed. So I want you to stay with me. I want to welcome you in, each and every one of you that are here on today. Whether you are right now in this live or watching the replay, I want you to know something. Today is not a motivational talk. Today is a diagnostic session. We're going to break down one of the most misunderstood gaps in personal and business finance: the gap between debt going down and cash flow actually improving. They look like the same thing. They are not the same thing. And by the time we are done today, you will be able to tell the difference. Here's what we are going to cover. First, I'm going to show you what actually reduces debt. Second, I'm going to show you what keeps your cash flow stuck even when the balance is declining. And third, I'm going to give you a simple 3-number exercise you can do today. And finally, we're going to open it up for your questions. Now, if you have a question, drop it in the chat. I will get to it at the end. I keep the Q&A at the end on purpose. That way you hear the full lesson first and your questions will be better. Trust me on that. Now, before we go any further, I want to ask you something. Have you ever paid down debt but still felt financially tight? Drop the word cash flow in the chat right now if that has ever been you. I can see it coming through, because what we're experiencing is not a willpower problem. It is a measurement problem. Let me show you exactly what I mean. First, let's talk about the real problem. The system gives you one scoreboard, but your financial life is being measured by 2 separate ledgers. And when you do not know both ledgers exist, you can spend months making payments and still feel like nothing changed. Here's what I mean, and I'm going to show you this because I want you to get this. So we see ledger 1 and ledger 2. Ledger 1 is what I call the debt reduction ledger. This ledger asks very simple questions. Is the balance going down? Is the principal being reduced? Are the interest and fees being covered? And the new charges, are they replacing the progress? Are there any new charges replacing the progress? This is the ledger the system shows you most clearly. Your statement, your balance, your minimum payment, right there. Easy to see. Then there's ledger 2. This is what I call the cash flow recovery ledger. This ledger asks totally different questions. Do you have more usable money after your obligations? Is your monthly margin improving? Could you handle an emergency without borrowing more? Do you have more flexibility than you had 3 months ago? This is the ledger the system does not naturally show you. Because the truth of the matter is this: the system is not designed to show you both ledgers at the same time. It is designed to show you the balance. What it does not show you is the connection between that balance and your usable cash. Most people are managing Ledger 1 and wondering why they still feel the pressure of Ledger 2. Now, there's something that we've got to understand clearly. The real problem is that the system lets you watch Ledger 1 while ignoring Ledger 2. I want you to do something today. Write that down if you're watching this, or screenshot it. Whatever you got to do, because that one sentence explains a lot of frustration people carry for years. Now, let me take you a little further and show you this. Ledger 1, and then we've got Ledger 2. Now here, Ledger 1, we've got a debt balance. But on Ledger 2, we have usable cash. Ledger 1, we've got the principal. But Ledger 2, we've got monthly flexibility. Ledger 1, we've got interest. Ledger 2, we've got remaining margins. Now, this is going to click in for you. Very important for you to get this. Ledger 1, we've got payment progress. Ledger 2, financial position. Let me ask you something. Which ledger do you usually look at first? The debt balance or the cash left over after all bills? You see, there are two different ledgers. The debt balance is Ledger 1. What's left over after all your bills is Ledger 2. What I want you to do is type 1 for the debt balance. If that's what you look at first, put a 1 in this chat. Type 2 if you look at what cash you have left over first. That's most important. Or put a 3 in this chat if you are looking at both, because it's going to tell me where you are starting from. And where you start determines what you can see. So we've got to go a whole lot deeper here on today. And I appreciate you coming in and sharing that information that's going to help us. Well, what actually reduces debt? Now we get into the first major teaching point for today. What actually reduces debt? This sounds like a basic question, but I promise you, most people do not know the real answer. And the gap between what they think is happening and what is actually happening is costing them months and sometimes years. So let me break this down into 3 principles that I want you to get today. Principle number 1, the principal must actually decline. When you make a payment, that payment does not automatically go to reduce your balance dollar for dollar. You've got to understand this. A payment gets divided. Let me give you an example. Say you make a $500 payment. That $500 goes to cover interest first, then fees, then any charges from the previous month. You've got to understand that order. And then whatever is left reduces the principal. So your $500 payment might actually look like this. Interest and fees, $150. New charges, $100. Actual principal reduction, $250. So your balance went down by $250, not $500. I'm going to say that again. Your balance went down by $250, not $500. The payment was $500. The progress was $250. These are not the same number. This is not an accident. This is how the system is structured. And if you do not know this, you are going to spend years wondering why the balance is not moving as fast as you expected. Principle 2, new debt cannot cancel the progress. You might be making payments every month, doing the right things, being consistent, and still not making the progress you expect. Now, the question you need to ask is why? Because while you're paying down one account, you may be adding to another account. Let me show you what this looks like. So you got card A, $5,000. You pay $400. The balance drops. Now card B, you had a car repair or a business expense or a medical bill, whatever it was, but card B went up by $350. So you got to understand this. Your total debt improved by only $50, not the $400 that you think. $50. Let me ask you this question. Have you ever paid off one account and then had to use another one before the month was even over? If you've ever had to do that, you actually impacted your debt differently than what it feels like. When we pay down debt, we feel like we've accomplished something. Listen, I want you to be very clear about something very important. This is not a character flaw. This is often a cash flow structure problem. When there is not enough margin after the payment, the next expense has to go somewhere else. And it goes to credit for most people, and then you're right back where you started. We're going to talk about why that happens in a moment. But principle 3, interest is a charge against the future cash flow. You got to hear that. Interest is a charge against your future cash flow. Every month you carry a high interest balance. These credit cards, that's what's happening for most people today. The system is collecting money from your next paycheck before you even receive it. That interest is consuming money you could have used for an emergency or for a business expense or a strategic opportunity. And here is the dangerous part. People will watch their balance go down while not tracking how much of their future income is being consumed by interest every single month. A lower balance and a lower interest burden are two different things. Now, you can have one without the other, and it's important. Let's get something here that's important for us. We've got to understand this, and this is important. A payment is not the same thing as progress. You have to know what the payment actually accomplished. Write that down. A payment is not the same thing as progress. You have to know what it accomplished, because the truth of the matter is, if you don't know either, you don't know whether your principal is actually declining, whether new debt is replacing the progress, and what your interest is truly costing you each month, you are managing a number without understanding the system behind it. And listen, my friends, that's not your fault. It's not your fault. That is the gap in financial education. One, the system never felt the need to close. Let me show you what the other side looks like now. What keeps cash flow stuck? This is important. This is the one that most important sections we're going to cover on today, because this is where the confusion usually lives. People do everything right on ledger 1. They make the payments. They stay consistent. They sacrifice. And then they look at their cash flow, and it is still tight. Here is why. Cause number 1. The payment is consuming your financial margin. When you make a payment, even a good, responsible payment, you are sending money away. That money cannot also be used for anything else. If the payment is large enough, it eliminates the room you need to handle the next thing, the next emergency, the next business expense, the next income gap, the next unexpected obligation. If every dollar of available margin is being sent toward debt, the balance may improve while the financial position becomes more fragile. Think about that. Your balance is going down and your position is becoming weaker. Both things can be true at the same time. The system does not tell you that. Cause number 2, your monthly obligations may be too heavy for your income structure. I see this all the time. Let me be very clear about some terms here. Gross income is what you make before taxes and deductions. Net income is what actually hits your account. You need to know that. Available cash is what remains after required obligations. Usable cash flow is what you can actually move or deploy without creating a new problem somewhere else. These 4 numbers are different, and most people only know the first one. They know their income. They do not always know their usable cash flow. And there is a significant gap between those 2 numbers. You could have solid income and still have very little usable cash because your obligations are consuming most of it before you can act. Cause number 3. Let's get this today. Payment timing is creating a cash squeeze. This one is overlooked constantly. Your income arrives on the 15th and the 30th, but your payments leave on the 1st, the 5th, and the 8th. Your income for the month may be perfectly adequate, but the timing creates a gap. You are sending payments out before the net income even arrives. And for those 10 to 14 days, you are operating with very little room. Let's get this, because we have to get this right, and we have to get this right today. We can't afford to be messed up. Look at this. Payments are leaving the 1st through the 10th. The income is arriving the 15th and the 30th. I want you to see this because you will be surprised how many people have this as their reality. This is why someone can have sufficient monthly income and still feel broke mid-month. It is a timing problem, not always an income problem. Not always an income problem. Not always an income problem. Cause 4. The system trains you to attack the visible balance, but it does not teach you to examine the structure producing the cash flow pressure. And trust me, that's where it's coming from. So you focus on the number you can see. You make the payment. You watch the balance decline, and the structure underneath, the timing, the interest load, the obligation to income ratio stays exactly the same. Same structure, different balance, and the pressure never fully goes away because you solved the symptom, but not the source. Not the source. And we got to get this today. We got to get this today. Now listen, this is important. Visible symptom is your debt balance. That's the visible symptom. But the hidden position is, what do you really have after all obligations? Usable cash flow. Now let me show you the difference between progress and positioning. They're not the same. There's a difference between progress and positioning. This is the analytical centerpiece of everything we're talking about today. Progress is what the number shows. Positioning is the actual condition of your financial situation. I'm going to say that again because I really want you to get this today, because you've got to get this straight or you're never going to build wealth properly. Progress is what the number shows. Positioning is the actual condition of your financial situation. These are not always aligned. These are not always aligned. This is critical if we're going to get it. So we got to look at something here, and I want to show it to you. All right. Now, measurement. What it tells you. Then we've got what it does not tell you. So let's look at the first one, debt balance. Well, here's what it tells you. What it tells you. Whether a specific balance is declining. But here's what it doesn't tell you. Whether usable cash is increasing. So the debt balance tells me one thing, but there's another very important thing it doesn't tell me. Minimum payment. What does it tell me? What the institution requires. But what doesn't it tell me? Whether the payment is strategically efficient. Does it make sense to make that payment? Credit score. What does it tell me? How your reported data is being interpreted. What doesn't it tell me? Whether your cash flow is healthy income. And this is important. Then we've got income. Here's what it tells me. Money entering the system. Here's what it doesn't tell me. What remains after obligations. Then we've got available cash. Here's what it tells me. Current flexibility. But here's what it doesn't tell me. Whether the structure is sustainable. I want you to look at that table. Every measurement the system naturally gives you is incomplete. Not wrong, incomplete. It tells you one thing. It does not tell you the thing next to it. And that gap is where the financial squeeze in your life lives. That gap is where it lives. If you're looking at the debt balance and you're only looking at what it tells you, you are missing the important thing that it's not telling you. Now, let me show you the most important example of today. This is important. This is critical. Two people, same payment, completely different results. Person A, they make a $500 payment toward debt. Their emergency reserves are still intact. Their income is arriving consistently. After all obligations, they still have usable cash left. Their balance went down and their position is stable. That's person one. Person B, they make the same $500 payment, but this month they had to use another card for groceries. Their emergency fund is empty. After all obligations, they have almost nothing left. Their balance went down by the same amount, both person A and person B, but their position is weaker than it was last month. That's person B's story. Same payment as person A, but their position is now weaker. I'm going to say it again. Same payment, different positioning. Same person, same habits, but different positioning, and it makes all the difference. Let me ask you a question right now that are watching me live or on replay. What matters more to you right now? A lower balance or more breathing room? A lower balance or more breathing room? I want you to do me a favor. Type balance or breathing room. What matters more to you? It's important. And I see it. I see you. If you're here in this live or you're watching this replay, I will be watching and pay attention to, because this is important. I see this because this is the truth. You need both. You cannot optimize for one while ignoring the other and expect the whole picture to improve. Now, let me show you what does not work. This is the what not section. Every lesson has a what not. And this one is critical. If you're going to be successful with this, it's critical because the things I'm about to describe are things well-meaning people do every single day. They are not failures. They are gaps. And once you can see the gap, you can start to close it. So what not number one? Paying extra without measuring your remaining liquidity. Extra payments are not automatically the right move. They may reduce the balance, but if that extra payment eliminates your operating margin, you are one unexpected expense away from borrowing again. And then the balance comes right back up. Extra payments need to be measured against what they cost you in available cash, not just what they accomplish on the statement. What not number two? Moving debt without changing the structure, a balance transfer, a consolidation loan, a refinance. These are tools, but a tool inside the wrong structure produces the wrong result. If you move the debt to a new account with a lower rate, but you do not change the cash flow structure, creating the pressure, the debt will rebuild. Moving the debt is not always the same thing as changing the position. I've got to say this again. Moving the debt is not always the same thing as changing the position. What not number three? Focusing only on the credit score. Your credit score is an important signal. I teach this all the time, but it is not your complete financial picture. Your score can go up while your cash flow stays restricted. Your score can look healthy while your month-to-month position is fragile. Credit is just one measurement. It is not the whole story. What not number four? Treating every debt as if it's identical. A credit card and a business line of credit are not the same. A car loan and a high-interest personal loan are not the same. A mortgage and a revolving credit card are not the same. Different debts carry different interest structures, different reporting patterns, different cash flow consequences, and different strategic risk. When you treat them all the same, you may be applying the right logic to the wrong account. What not number five? Believing that discipline is the complete answer. Discipline matters. I'm not saying it doesn't matter, but discipline cannot replace diagnosis. If the structure is wrong, working harder inside that structure produces more effort with the same result. The real lesson is this: you cannot repair a system you have only measured from one angle. Oh, this is important, and I'm going to make sure you get it. Today, we got to get this. We got to get this. You cannot repair a system you have only measured from one angle. Now, let me walk you through a live example to bring all this together. And I want you to see it. I really want you to get this. So, this is a fictional person, but a very real scenario. One viewer has $20,000 in total debt, $900 in required monthly debt payments, $4,500 in monthly take-home income. After fixed expenses and debt payments, there's $500 remaining each month. Now, they decide to pay an extra $300 toward debt this month. Question one: does the debt balance decline faster? The answer is yes, possibly. The extra payment hits the principal and the balance moves in the right direction. But other factors are going to be important. Question two: does cash flow improve? Not immediately, because now they have $200 remaining for the rest of the month. That's $200 to cover any unexpected expense, any business costs, any income gap, any emergency. And here's what often happens next. Something comes up, and you know it's the case. because something always comes up and $200 is not enough. So they put $150 on a card. The balance they just paid down comes right back up. Net progress, less than expected. Financial position, no better than before. Now look at the measurements. Debt reduction, technically, yes. Monthly obligation load, unchanged. Remaining usable cash is smaller. New borrowing after the payment, possibly, yes. For a whole lot of people, interest and fees, still running. Still running. This is why two people making the same payment get different results. It is not about the payment size, my friends. It is about the structure around the payment. Looking at this example, would you rather have a faster debt reduction with less margin, or a slower reduction that preserves operating room? I'd love to know what you think. Would you rather have a faster debt reduction and have less margin to play with, or a slower reduction that preserves operating room so you don't have to increase debt? I'd love to know what you think. I want to hear several people. What is going on with you in this particular area? Because the right answer depends on your specific position, your income structure, your business cash flow, your obligations, your risk exposure. That is exactly why I'm not going to give you a one-size-fits-all answer today. What I'm going to give you is a tool to examine your own position right now. This is critical. This is your free takeaway from today. I want you to write down 3 numbers real quick. Get a piece of paper, open your note app, whatever works for you. I want you to write down 3 numbers that are going to be very important and essential. And let's look at this. Number 1, your total debt balance. Add it all up. Every account. What is your total debt balance? How much? How much do you owe? How much do you owe? Number 2, your total required monthly debt payments. Not what you want to pay. What are you required to pay across all accounts? What are you required to pay? So we've got total debt balance. Number 2 is total required monthly debt payments. All right. Number 3, your usable cash remaining after all required obligations. So when you make all those debt payments, how much do you have left? After rent or mortgage, after utilities, after debt payments, after fixed expenses. What is actually left? I want you to think about that today. What is left? Get those 3 numbers. Now ask yourself some questions. You've got to get the numbers. I want you to, again, number 1, your current total debt balance. Well, you know what? I owe a total of $400,000. I owe a total of $75,000. I owe a total of $28,000. What is it? What is the total monthly debt payments? I pay $2,344 a month. One of the good things, I often use people for smart credit for monitoring purposes, and it gives you these 2 numbers. Number 1 and number 2 specifically. Your usable cash remaining after all required payments. So here, what are you bringing in a month, and what is your required debt payments? What do you have left? What's left after all obligations are paid? Now ask yourself these questions. Which number is improving? Number 1, number 2, or number 3? Which number is improving? Which number is still under pressure? Are you paying down debt while creating new debt somewhere else? Is your cash flow margin expanding or shrinking from month to month? Do you have more left month to month, or is it actually getting worse? You do not need to share those numbers with me, but I want you to sit with them for some time today. Get them, sit with them, and get clarity. because those three numbers will tell you something your statement will not. They will tell you whether you are making progress or whether you are repositioning pressure. Listen, my friends, there's too many people, maybe you watching me today, maybe watching this replay, who are simply repositioning pressure. That's all you're doing when the money comes. And that is the distinction I want you to carry into every financial decision going forward. Now, I want to share something with you that ties all this together. It ties it all together. So if you've been paying debt and still feel financially stuck, I need you to hear this. That does not automatically mean you are lazy. It does not mean you are careless. It does not mean you are incapable of managing money. It may mean you have been trained to measure debt reduction without measuring financial position. You're seeing a balance and you know you're making a payment, but you're not paying attention to what that number is not saying. A lower balance is useful, but usable cash is what gives you room to operate, room to handle the unexpected, room to grow your business, room to say yes to an opportunity instead of borrowing to reach it. A lower balance is one measurement. A better financial position requires both ledgers, and nobody showed you the second one. And if they didn't, it hurts you. If that gave you a different way to look at your situation, it's important today you understand your position. And I want to tell you something. You can build an effective position, an effective financial position, when you understand both ledgers, when you understand what the measurement may not be automatically showing you. Now listen, this is important. You have probably been told your problem is discipline, or someone says it's budgeting, or simply working harder. Those things may matter, but they may not be the root problem. The deeper issue may be a financial system you've not been shown how to see yet. So I built a free tool to help you identify which layer is creating the most friction, and you can learn it in about 5 minutes. It's called the CBL Financial Positioning Diagnostic. Listen, the link is in the description for this video. No cost whatsoever. No pressure, because nobody's going to know. Just clarity. Again, the link is pinned for you to understand it in this description. Take 5 minutes. After this live, you will know more about your actual financial position after those 5 minutes than most people learned in years of making payments. Now, let me tell you what comes next. The diagnostic helps you identify where the friction is, but identifying the friction is not the same as having a complete plan to move through it. The CBL Wealth Blueprint is designed to take you further. CBL stands for Credit, Business, and Life. And the blueprint is built to help you do 4 things. First, diagnose your actual position, not just the visible balance. Second, sequence the next moves based on your specific situation. And third, connect credit, business, and life instead of treating them like 3 separate problems. Fourth, build a complete implementation pathway, not just a list of tips. The free lives help you see the problem. The blueprint is designed to help you move through it. If that's something you're ready for and want to do, well, the information is in the description. And do me a favor, if you would, subscribe to this great channel. Hit the like button, because we want many people to see this so that they will be on top of this information just like you. Drop a comment below and let me know, when you pay down debt, does your balance improve while your available cash still feels tight? When you pay down debt, does your balance improve while your available cash still feels tight? Your comment helps other people find this necessary conversation. Now, before you go, I've got to help you. I want to get these questions. I've had some questions sent to us while we've been talking. And if you've got a question that you want to put here, you can also do that as well. But I've had some very, very good questions that we are going to take a look at right now, because maybe this question helps you too. And if you've got another one, please submit it. If someone has not submitted and you want to, well, again, this is a great time to do it. But here's a question. Should I pay extra or preserve cash? Good question. That depends on your Ledger 2 numbers. So make sure you look at Ledger 2 numbers. If your cash flow margin is already thin, a large extra payment may expose you to the next unexpected expense. And you've got to think about this. You got to think about this. So the first question is not how much extra to pay. The first question is what your usable cash position looks like before you make that decision. See, that's exactly what the diagnostic is designed to help you see. All right, here's the next question. Very important. Very important. What if I'm using one card to pay another? Now, that's a structure issue, not a character issue. When cash flow is tight after obligations, the next expense has to go somewhere, and it usually goes to credit. The goal is to examine the total obligation load and your timing, not simply to tell yourself to stop using the card. If the structure is creating the behavior, and that's important, the behavior will not fully change until the structure does. I want you to really get that. Many times what we're doing it because of the structure we're in. And so we don't have something in place to deal with the current crisis except what we've been doing for a long time. And so we've got to look at the structure so that when new situations arise, we can handle them a different way. Question number 3. Does a better credit score mean my cash flow is improving? Wow, that's a great question. Not automatically. A credit score reflects how your reported data is being interpreted. I want you to understand what credit score is. Credit score just simply says how well this person manages debt. It's an important measurement, but a strong score and restricted cash flow can absolutely coexist, because you may be managing debt very well, but you have no margin. I see this all the time. The score is Ledger 1. The cash flow is Ledger 2. You need both. Listen, my friends, you're going to want to go back. If you didn't, go back and review this. You need to know the score is always just Ledger 1, but cash flow is Ledger 2. And if you don't get both of them working together, your position will not improve. I want to respect your time, so I'm going to wrap this up. Here's what I want you to remember from what we shared today. Debt reduction is a measurement, but cash flow is a position. You need to understand both before you decide what progress really means. A lower balance is very useful, but usable cash is what gives you room to operate. And the system is not going to show you the full picture on its own. That's your job now. And you have the tools to start doing it. The 3-number exercise that we talked about, the 2-ledger framework, and the CBL financial positioning diagnostic that's in the description. Use all 3. The 3-number exercise, the 2-ledger framework, and the CBL financial positioning diagnostic. I've given you 3 powerful tools that will change your financial position if you use them. Now, come back after you do and tell me what you found. And if today helped you, share it with someone who's making payments and still feeling the pressure, because they need to hear this same information just like you. And listen, to every one of you, I appreciate you watching. I appreciate you sharing. I appreciate you commenting. I appreciate you liking. I want you to be blessed. I want you to have an absolutely excellent and awesome rest of the day and rest of the week. And listen, let's work to change our financial position by seeing that we're paying full attention to the structure we're operating in. Be blessed. I'll talk to you soon.